Hey guys, Marcel LeBlanc here, Certified Financial Planner, and today I want to talk to you guys about where a person's need for life insurance comes from. So, every person, every couple, every family has different circumstances and therefore different needs for life insurance. So not everybody needs $1 million and not everybody needs just their debts to be covered, okay? Some people might be able to get away with just a little bit of life insurance they have at work and their mortgage being covered at the bank. But for most people, that will not be enough. You have to look outside and try to figure out, okay, this is my situation. How much do I actually need to support, my loved ones, my surviving family, if anything were to happen to me or my spouse and vice versa, or to both of us, right? So the big need obviously comes from two places. I say obviously is because a lot of people, when asked whether they want their debt covered for life insurance, they say yes. The concept makes sense. So yes, it's obvious that that portion of your needs is a large portion. When you look at mortgage, lines of credit, student debt, or whatever, it's a large amount of money usually. So it's obvious to most people that yes, I want that to be covered if anything were to happen to me. Now, the other amount of need for life insurance is a little less obvious, and that's where sitting down with a qualified insurance advisor to calculate your need will go a long way. So let's consider, you have so much money coming into a household, right? Whether you have kids or no kids, but the need goes up a hell of a lot more when you have kids because you have to support them for so many years. But there's so much money coming in, and for most people, their financial obligations are pretty close to what comes in. You hear the age-old, I don't know where my money go every month. We're living almost paycheck to paycheck. So if that's how much money's coming in and those are your obligations, if you pay off your debt, the bank lets you borrow 30 to 40% max of what you're making. So your obligations do go down, quite a bit, 30 to 40% tops. So that means if one spouse dies, the surviving spouse has to maintain 60 to 70% of the other expenses that are left over. Why do I use 60 to 70%? It's because it's not true that your expenses are cut in half because one spouse is gone. Your property bills will keep going as they were before. Your phone bill will keep going, 100% of what you were paying on it before. The only things that really are cut back a little bit are hot water and groceries. Everything else, childcare, hockey, whatever for the kids and whatever for the surviving spouse will keep going. And you're going to want to maintain the same lifestyle for everybody. So if you have young kids and you have to support them for 15 to 20 years, that 20 to 30 to 40% buffer between the surviving person's spouse and the household expenses, you multiply that over the amount of years you have to support it, that plus your debt amounts to a lot of insurance need. So again, not everybody needs the same amount of insurance. Some people barely need any life insurance because, they don't have kids, don't have spouses, and don't have debt. Well, then your need for life insurance is fairly limited. But for most people, everybody else that does have financial obligations and personal obligations to other people, having a discussion with an advisor to calculate how much you need, what products fit your budget, what products fit your lifestyle is very, very important because the risk of premature death is a real risk and it's a risk you should protect. So if you have any questions regarding life insurance or anything else financial planning, you can contact me directly through marcelleblanc.ca, and remember, my advice is free and it always will be. Cheers, guys.